Hi everyone. In this video we are going to look at two things. We're going to look at EOQ. We are also going to consider price discounting when it pertains to EOQ. So let's get started. Here you see a picture of a product that a company could sell. And if you're familiar with this, you may recognize that as Groot. Actually, I think it's Baby Groot, to be a little bit more precise, from a recent film, not really too recent, but let's walk down this fictitious company that I've created for this example. So we have a company called Groot's Bonsai Trees, and that's that image that you saw over there. And let's just take a look at the company and understand a little bit about what it is that they do and some of the data that we're going to need to understand what EOQ is, economic order quantity. And then we'll look at a price discounting scenario as well. Okay, so a bit of information. We know that Groot's sells miniature bonsai trees. That's what we see here. They're located in Winnipeg, Manitoba. And they have daily demand between 65 and 85 units. And I'm putting you in this situation saying you, but you've performed some basic math and you know that they sell 73 units per day. Okay, so that's going to be a piece of information we're going to use. And last month you calculated a standard deviation of demand to be 16. Might not need that, depends on what we're going to do. For EOQ we don't need that, but if we were doing something like safety stock we would. GBC orders trees from a supplier in China and it takes 39 days to arrive. But once it's at GBC, so Groot's Bonsai Trees, it takes 2 days to be put away. So here's something interesting. We know right from the write-up that lead time is typically important, and lead time for this one is going to include the 39 days in transit time plus the 2 days of put away. So our lead time is actually going to be 41 days. Okay, that's what we're going to be using for this particular calculation. Now that may be important to us again, and maybe not. For economic order quantity, we don't use that. But remember, if I'm asking you, or if you're being challenged in a way to calculate safety stock or something, that would be important to you. Okay, let's look at some other information that we have. You, in this particular challenge, have been asked to figure out this wonderful thing, economic order quantity, which of course, as we know, is the balance between the cost of holding and the cost of ordering, and it really is a number. It is a quantity of units, or a number, that is ideal. And it is that scale that we talk about to say, hey, we have our cost of ordering and we have our cost of holding, and how do we kind of balance those out so that we pay the least of the combined of those two totals? So our objective here is to pay as little money as we can. That makes us happy. Okay? All right. So let's go back to our example here, and we know a few things now in reading this. In anticipation, you've gone to the accounting group, and they've told you that your cost of capital, I'm going to change colors here, is 21%. Please remember, cost of capital is not the same as cost of borrowing. We do use that, we do get that number from the accountants. It's much more complicated than just saying what our borrowing cost. You're more correct to think of it as an ordering opportunity cost or something of that nature, okay, and not just strictly borrowing cost. Okay, we know that our landed bonsai tree is $14 Canadian. We are going to need that. And if you did a little bit of homework, in this example I'm proposing that you did, you would eventually find out how much it costs to order something. And in this case, we're saying that the cost to order was $300. So you know that, okay, you've taken a look at the process. Somebody's ordered the bonsai trees by maybe email. They've received them and put them away into the warehouse. That typically takes the most amount of the expenses, the labor to unload them and put them away. And then maybe you have some ERP updating, those types of things, and eventually you got to pay a bill. So in this case, we're saying, hey, that we know that every time we place an order, it's about $300. We also need to know, what our annual demand is for the formula. So we know, given this write-up, that CBC, or GBC rather, Groot's, is open 363 days. Okay, so that's the basic information. We're going to come back to some of that, but we have based on that, we have the pieces of the puzzle that we need to calculate EOQ. And again, in this video, we're not going to talk about what EOQ is. I'm kind of assuming that you already know, but we will look at the formula. But you've already done a little bit of work with EOQ to understand, what it is and the objective. Again, it's the balance between the cost of holding and cost of ordering. It spits out a quantity, and ideally that quantity would be amount that you would order if you had to place an order, okay, if you had no constraints on the order. So let's take a look at what EOQ is. So I'm going to stay in green here. So economic order quantity. It is the square root, and you're going to see this formula set up a couple of different ways, but they both work out to be the same. So it is always 2 times demand. This demand, though, is very specific because it's annual demand. Okay, and that's pretty important that we get that piece of it right. Times the cost of ordering. Okay, so that's O, divided by the cost of holding. Okay, now in some instances and many books that you will read, you will see the formula. You won't see that piece of it. You'll see the whole formula divided by the cost of holding. Both mathematically work out to be the same. So don't be intimidated by either formula. I think the hardest part in this entire formula is remembering that demand, it's annual demand. It's not daily demand, it's not weekly demand. For this formula for EOQ to work, we need you to calculate that based on annual demand. Okay. All right, so here's the data that we need. So I've done a little bit of the homework already for you. So we know that annual demand, Groot's is open for 363 days of the year. They do close on New Year's and Christmas Day. We know that from the write-up. And on average, they sell 73 units a day. So that means that their annual demand, this is annual, is going to be just under 26,500. So 26,499 is going to be the annual demand. Okay. We also know that the cost of ordering is $300. Again, we've done that homework, right? You've looked at the processes and the labor and estimated come to an amount. Okay. And for this, we do assume that remains constant. That whenever you place an order, it's the same amount. Okay. Now the last piece of it does take a little bit of calculations, and if you'll remember from the original write-up, our unit, the cost of our unit was $14. And we had a 21% cost of capital. So every time we put something on the shelf and if we leave it for a year, it's really $14 times 21%, which equals $2.94. Okay, so we have the pieces that we need to plug into our formula up there. So I'm going to change, I will do this in blue. So our EOQ, let me get this right here, our EOQ is equal to, so let's fill this in. So we are going to do the square root of 2 times. Our annual demand is up here. So we're going to drag that down into our formula here. So I'm going to change back to blue. So that is 26,499. Okay. Now we're going to finish out. We're going to look at our cost of ordering. So our cost of ordering is $300. And for ease, I'm just going to do this the same way that your textbook does this, or most books rather would do this. And your cost of holding is $2.94. Okay, so that's what our formula looks like. So let's shorten some of this up and do some of the math. So bear with me as I get my calculator out here. And this is probably not going to round to a nice, neat number for us, but we'll round it the correct way. So 2 times 26,499 times 300 and divided by 2.94. So you should come up with a number. Oops. You should come up with a number around, so the square root, sorry, give me a second, guys. Let me do the long form of this so we see exactly what we're doing. I'll do it before the square root. So 2 times 26,499, which is our annual demand, times 300. So the top part of our equation is 15,899. Oops. Those are commas. 400. And the bottom half stays the same at 2.94. Okay, so you will get, let me divide that, divided by 2.94 is equal to 5, the square root of 5,407,000 959, and we have a couple of decimal places. Okay, so let me figure out the square root of that, and the square root of that is equal to 2,325.5 019, you'll get a bunch of different numbers. So this is a decimal. So this is interesting. Now, normally in some of our calculations, rounding really matters. In this case, it doesn't. Just use traditional rounding rules. So what this means is that 2,300, and I'm going to round this up, 26, is our economic order quantity. So for this particular solution, given all the information that we have, our EOQ here is 2,326 units. And remember, what that means, quite simply, is that all things considered, if you were given the choice with no constraints on how much to order, you should order in increments of 2,326 units. What does that do? It just simply balances the cost of keeping something in inventory versus the cost associated with ordering it, because we do want to try to minimize those two. And again, I'm going on an assumption that you already have a basic understanding of the functions of EOQ and why we perform it. Okay, so we have that. But one of the things that's very common, and this is the scenario that I want to talk about, is a scenario where your supplier would come to you and say, listen, I've got a deal for you. I'm going to give you a 5% discount if you order 5,000 units at a time. Okay, so very common, right? Where you'd end up in business and someone would say to you, hey, if you're willing to take more of a product, or this works for me because I fill out a full container, there's some advantage to the supplier, they'll quite often give you a discount. So we can use, and this is what you will do quite often with EOQ, because you'll calculate EOQ, but then you'll be looking at different offers from the supplier to figure out whether or not it makes sense. So here's how we would determine whether or not that would make sense. We would use EOQ and figure out our total cost if we ordered under EOQ. The difference is that we're going to add in the cost of the product itself. Okay, so let's see what that looks like. So we're going to do scenario 1 here, and then we'll do the second scenario, which applies the price discount. So I'm going to stay in red for scenario number 1, and in scenario number 1, we are ordering in increments of 2,326 units. That's EOQ. We figured that out just a minute ago, right? Now, our annual demand doesn't change just because we're ordering. We're still going to order 26,499. Our cost of ordering, that doesn't change, and neither does our cost of holding. We had to figure that out for the basic calculations. So for this, really all we're going to do is begin to fill in some blanks, okay? So our cost of ordering is simply, hey, how many orders do we need to place? This is a question, right? How many orders? Well, we know that we are going to ship, or we're going to have demand for 26,499. Now, if we order in increments of EOQ, which is 2,326, let's figure out what that means, how many orders we would have to place. 26,499 divided by 2,326. So we would be placing 11.39 orders. But we're going to simplify that, and we'll just say we don't order fractions of orders. We're going to order 12. So we're going to place 12 orders throughout the year. Now, the last order won't be complete. It won't have 2326 units on it, but you get the idea. Okay, so 12 times our cost per order of 300. 12 times 300 is $3,600. Okay, so that's your cost of ordering, because you're going to have 12 orders. Every time you order, it's going to be $300. Okay, so that's step number 1. Now, our cost of holding, we have to remember something in cost of holding, is that whenever we calculate cost of holding, we calculate half of whatever our quantity is times our cost of holding. Okay, so our quantity in this case is 2326. Now, half of our inventory, 2326 divided by 12, is, 2326 divided by 2, not 12. So half of Q, right, half of Q is 1,163 units. Now, our cost of holding in this particular case is $2.94. Again, we're getting that. I'm going to change colors. We're getting that up here. Right, our cost of holding that we've already figured out is $2.94. So that means that our cost for holding is $3,419. I'm going to skip the pennies. I'll just round that to the dollars. It's 22 cents, but I'll get rid of the pennies for that. Okay, so we got two things now. We've got our cost of ordering. We've got our cost of holding already set up. Okay, and again, cost of holding, we need to understand, and this shouldn't be, or it should be familiar to you, whatever we order, simply half of that is our average inventory. We always apply our holding cost to half of our average inventory rate. Okay? All right, now the cost of the product itself. This is pretty easy because we need 26,499 units and they're $14 a piece. So that quick math means that our product is going to cost us $370,986. Okay? So we're going to add all those up. So 370,986 plus our cost of ordering is 3,600 plus our cost of holding, which is 3,419. These are pretty small. Okay, so our total cost under this scenario number one, ordering at EOQ, is $378,005. Okay, that is our total cost under scenario number one. Let's price out scenario number two. Okay, so a couple things change in scenario number two. So in this scenario, we're attempting to test the offer of quantity Q not being EOQ, quantity changing to 5,000. So we don't have any change here in annual demand. That stays the same. We don't have any change in the cost of ordering. Excuse me. But we do have a change in the cost of holding, because our cost of holding is a reflection of the cost of the product. It doesn't cost us $14 anymore. That is wrong, because they're taking 5% off of it. So this math, let me undo my little scribble here. 14 times 0.95, or a 5% discount, is actually $13.30. So the new cost of holding per unit is $2.79. Okay, so let's do this again. So now our cost of ordering, we need to figure out, we're still going to ship the same, or we're still going to order the same number of units, but this time we're going to be ordering in increments of 5,000. Okay, so 26,499 divided by 5,000 means that we are going to need 5.29 orders, but we're going to make this simply 6 orders. Okay, now 6 orders at $300 a piece, right? Because our ordering cost doesn't change. Means, let me scroll over here. I'll put these on the outside. Is that I'm going to change colors here. Our ordering cost is $1,800 in this case. Sorry, 18. Okay, so that is our total cost under the second scenario for cost of ordering. So let's figure out cost of holding. Now remember, cost of holding is applied to average inventory, and average inventory is half of Q. So half of Q in this case is 2,500, because we're ordering in increments of 5,000, again, remember. So 2,500 times our new reduced holding cost, which is 2.79. So 2.79 times 2,500 is 6,975. Okay, just a couple things. So let's look at the two scenarios side by side. I know it's a bit small, and I'm going to change to yellow. So the cost of ordering in scenario number one, $3,600, because we're placing 12 orders. We're placing fewer orders, right? We're only placing 6 orders, so of course that cost is going to drop in scenario number two. But conversely, you give one, you're going to have to give in the other. So in the first one, we're ordering in lower quantities, and we're applying that holding cost to a lower average inventory. So we have $3,400 in expenses and almost $7,000 in expenses. Okay, but I mean the majority of our expenses in the cost of product. So this may end up being a pretty good deal for us, because we still have to figure out what the cost of the product is with the 5% reduction added to it. Okay, so the cost of our product is still $2,799 $26,499, right? But instead of it costing $14, our new discounted price is $13.30. Okay, so what does that equal? $13.30 times $26,499. So our new total product cost goes to $352,436. I'm losing the pennies. I think there's 70 cents added onto that. So I'm just doing a little bit of basic rounding. So again, I'm going to add these three things. I'm going to add our holding costs. I'm going to add, or our ordering costs rather, our holding costs, and I'm going to add the product cost. So let's see what this equals. 352, 436 plus 69.75 for holding plus our ordering cost of $1,800. So in this scenario, our net expense is $361,211. All right. Okay. So which one is going to make you most happy? This one is going to make you most happy. Scenario number 2. Okay. And it's simply because the net expense is lower, right? You have one scenario where you're ordering at EOQ and it is going to cost you total $378,000. You have another scenario where they offer you a discount based on a 5% rebate for ordering in increments of $5,000. You do carry a little bit higher inventory, but that's really offset by the savings in the overall product expense, and you're able to reduce, which is a good thing. You're able to reduce your overall expense here to $361,000, right? So I mean, you're talking about a pretty significant savings. It is a savings of almost $17,000, so $16,794. So in this scenario, you would take scenario number 2. You would take the offer from the customer on the 5% discount. I hope that helps. If you have questions, please let me know. Thanks.